Hello, everyone, and welcome to session 5 of financial statement analysis. In our previous session, we discussed revenue recognition policies, how to decode a revenue recognition policies, and if revenue recognition policy changes, how to analyze numbers and incorporate those impacts in numbers to ensure they become comparable over a period of time, so that you can conduct a time series analysis of a business and come up with interpretations around CAGR of revenues or growth rates around revenue figures. In today's session, we are going to discuss how to incorporate, if any accounting standard changes happen, how to incorporate that change in your analysis. Now, accounting standard changes don't happen that frequently. However, let's say if you're analyzing in a time series fashion for any business over a horizon of, let's say, 5 to 10 years, it's quite possible if you go through something like this, it's genuinely important for us to incorporate those changes to make sure the figures are comparable on a time series basis. Now, in today's session, we are going to discuss one such event which happened in 2019 as a case study in point. Now, in FY19, accounting standards for revenue recognition policies changed from IND AS 18 to IND AS 115. Now, without getting into technicalities, what used to happen earlier, there was an obsessive focus around reward and risk approach. And in IND AS 115, that approach changed to control approach. Now, these words may sound very much similar. However, this accounting standard change led to a crazy impact in businesses belonging to sectors telecom or IT or engineering, even construction or real estate businesses, where there are long-term contracts with customers. It is this long-term contracts revenue recognition policies which changed across these industries, and we saw huge impacts of revenue recognition across these industries. Let's take a case study in point to understand how to go about analyzing revenue figures when something like this happens and make sure those figures are comparable. All right. Now, the case study in point to discuss IND AS 115 transition is Mahindra Holidays. Now, Mahindra Holidays as a business sells holiday packages to their customers of a long-term membership, something like a 15-year or a 25-year membership to their customers, for them to be able to visit holiday resorts during that horizon at a flat fee. Moreover, there is a small percentage fee, which is annual membership fee kind of thing, which happens. However, majority of the revenue for these businesses are generated through vacation ownership, precisely the model which I discussed about. Now, what happened was in 2019, the accounting standard changed, impacted this business crazily. Let me show you how. Now, on my screen, I have 2019 annual report of Club Mahindra. Now, let me directly move to the income statement now, which is present on page number 172. When you take a look at the income statement on 172 page number, taking a look at revenue from operations, you'll see it's slightly in a degrowth manner, which may be possible. However, raises questions when you take a look at the quantum of it. Here, it may seem minuscule. Let me actually walk you through the note 33 to understand what kinds of individual items are contributing to revenue from operations for Mahindra Holidays. The note 33 is present on page number 214. So when we open this 214 page number, you can see note number 33. You'll see that vacation ownership income is nearly halved as compared to 2018. Now, that raises question, what exactly happened? If an analyst were to directly blindly take numbers, they would think that the business went through degrowth and there was some bit of a slowdown. Maybe perhaps we need to look a bit deeper, understand these figures a bit deeper rather than just taking data and jumping to the third step of financial analysis. Now, to actually understand this, let me also show you the impact on a standalone level. Now, I have not really explained what's the difference between consolidated and standalone so far in our series, but a broad level understanding is consolidated is the entire family, including parent company and subsidiaries. However, standalone, on the other hand, is just parent company. So consolidation or consolidated figures are for the entire family of the companies, and standalone is only for the parent entity. Let me actually show you the impact on page number 24. Now, page number 24 is just a financial highlight of the standalone figures. However, when you take a look at these figures from 2015 to 2018, there was literally one-sided growth for the business, except in 2017, where there was a flattish kind of revenue. But in 2019, you would see a crazy amount of dip in revenues. And precisely what we have done is we have shown the calculation of the growth rates year on year. An analyst would think that in 2019, the business at a standalone level saw a degrowth of nearly 14%, which you can see in our blog here, 13.7% drop in revenue. Now that's significant. Naturally, you can also see here that the figures are presented as per the accounting standards. So IND AS 18 from 2016 to 2018, and in 2019, it's IND AS 115. Now let's understand what exactly changed. What do you mean by IND AS 18 and IND AS 115? What was the broad level change? This change has been brilliantly explained. So whenever a business sees this kind of drop in revenues or any significant accounting standards change, you will always find some bit of commentary either by the chairman of the business, or you will also find some discussion around the same in investor presentation or con calls of that business. So let me actually, scroll down to the chairman's speech, as you can see on the screen here. Take a note of this paragraph. In April 2018, Mahindra Holidays adopted IND AS 115, which requires income from vacation ownership contracts to be recognized over a tenure of membership. And prior to this, what used to happen? The accounts were prepared according to IND AS 18, where 60% of sale of vacation ownership, that is the non-refundable part of the fees, was recognized in the year of sale itself. And the remaining balance was recognized over the tenure of the membership. Let me take a dummy figure and explain it to you how this impact can be explained numerically. All right. So let's say I am Mahindra Holidays and I sell a 25-year membership for, let's say, 5 lakh rupees. Now, earlier in IND AS 18 for FY 18, what used to happen? Let's say I sold this membership on 1st April 2017, which happens to be the first working day of FY 18. So 1st April 2017, we sold this 25-year membership at 5 lakh rupees, which is the first working day of FY 18. Now, earlier, what used to happen is this 5 lakh rupees, 60% of this 5 lakh rupees used to be non-refundable, which is why the businesses, in any case, bared no liabilities whatsoever in terms of delivering, and it was made amply clear to the customer that this part, 60% fees will be non-refundable. So which is why businesses used to recognize 60% of the fees as upfront revenue, which is mentioned here. Take a look at this. 60% of sale of vacation ownership membership, that is the non-refundable fee, was accounted for income in the year of the sale. So what happened was, let's say this was FY 18. So out of this 60% fees, which is 3 lakh rupees, was recognized as upfront revenue in FY 18. So we were left with a deferred revenue figure of 2 lakh rupees on the liability section of our balance sheet. I think we discussed this in our reading when we were understanding different revenue recognition policies for Just Dial business. So please refer to that. If you haven't taken a look, please do take a look the revenue recognition policies recording. Now, what happened was 3 lakh was recognized as revenue, 2 lakh was left as liabilities. Now, what they are explaining is, earlier, what used to happen is this 2 lakh used to be recognized over the remaining life period of that contract, which was 24 years, because remember, 1 year is already gone now. So this remaining 2 was recognized over a period of, let's say, 24 years. And every year they used to recognize 1 by 12 as revenue, 1 by 12 lakhs as revenue. However, what happened was, let's say as soon as, we saw 1st April 2018 hit. So 1st April 2018 was FY 19 figure. On the right-hand side, you will see on 1st April 2018, this deferred revenue balance was obviously 2 lakh rupees, as you can see. But they said we need to change the accounting policies because of the accounting standards mandate to IND AS 115. Now, as per IND AS 115, because this is a live contract, all live contracts were to be recognized on a pro rata basis over a period of membership, which means this contract used to have a value of 5 lakh rupees, and you should have recognized 5 divided by 25 every year. Now, one analyst may think already they have recognized 3 lakh rupees in the previous accounting year. How do we change that now? And every year they used to recognize 1/12 as per the old accounting standards, but and the upfront 3 lakh rupees in the first year of sale itself. But now, let's say, even if you make a new sale, you will have to recognize only 5/25 of that new sale in the first year and every year subsequent. So what happened was the 60% revenue which was booked upfront was no longer hitting the revenue line item, but it used to hit the revenue line item 5/25 every each year. So imagine a contract sold under 118, 115. It used to have revenue in the first year to be 5/25. And in IND AS 18, it used to have a revenue of 3 lakh. This is why you see a huge drop in revenue under the new accounting standards. Now, you may ask this question, what happens to the contract which are live and for which we basically recognized too much revenue in the first years as per the old accounting standards, which was fine, by the way, because if you open the revenue recognition policies of your competitors, you will see that even the competitors were following the same thing. As you can see here in Sterling Holidays, you will see even they were recognizing 60% of the product value in the same year itself. This is a revenue recognition policy screenshot of Sterling Holidays, a peer of Mahindra Holidays. Now that raises questions that how is it that the old revenues which were recognized aggressively, how is it that you are going to adjust it? So the previously recognized revenue overstated equities in the current accounting standards. क्योंकि जहां पे आपका 5/25 जाना चाहिए था, वहां पे already 3 जा चुका है, which was aggressive in terms of the new accounting standards. So what new accounting standards did, they backed out this figure from equity. Equity mein, they backed those aggressive revenue recognized figures as per the new accounting standards and started passing it one by one, piece by piece, for every contract 5/25 every passing year. Just a simplified way of explaining things. So, which is why when IND AS 115 came, equity saw a huge drawdown, or rather most of the equities of the business saw a huge drop because those equities were backed out and placed in deferred revenue in the liabilities section, because now as per the new accounting standards, they are no longer earned in the eyes of IND AS 115. And every year you earn it pro rata basis, each 1/5, 5/25, 5/25, 5/25. And likewise, this is just a simplified way of explaining, assuming that the contract was sold on April, let's say 1st April 2018 or 1st April of the, the first day of the fiscal year. However, if the contract was sold during the time period of the year, which usually happens for a business, the pro rata period would be the tenure in which it falls in the current fiscal year, and likewise. So which is why, IND AS 115 saw a huge impact on revenue, because again, explaining this, remember under the old accounting standards, in the first year, 60% revenue was recognized. So let's say if it was a 5 lakh membership, in the first year, 3 lakh was recognized, and under new accounting standards, only 5/25 is getting recognized. It's very minuscule as compared to what earlier used to happen, which is why prior to FY19, all figures would seem very high and FY19 figures would seem low. Hence, you see a huge drop in revenues. Now, imagine an analyst who is just picking revenue figures from, let's say, a secondary source and using it for analysis. He would think that Mahindra Holidays has seen a drop in revenues, which is completely wrong. Because ideally, you should take a revenue figure which is comparable. How can you compare a revenue of 5/25 to 3 lakh? Because when both the revenue recognition policies or the accounting standards which are applicable here is completely different. Which is why it is genuinely important for every analyst to understand how to source that data. And before you jump to the analysis part, understand that data. Until you understand the data, you will not be able to make clear and, adjustments to the data to make it comparable over the years. Now, you might actually think, how is it that we are going to make this comparable? We don't really have that visibility that Mahindra Holidays sold how many contracts on which particular date, and how is it that we are going to calculate each and every line item, the kind of equity impact which you will see. It's going to be a crazy one. By the way, the thing which I just explained, that the revenue figures were overstated and equities were backed out, and eventually a liability was created, you can take a look at this. The company now has significant deferred revenue. Once again, deferred revenue is the contract liability kind of thing, while the deferred costs are only this. This will augur well for future as it will significantly improve profitability. So naturally, the costs have also gone down because the cost of acquisition of business, which the business used to incur, even those 60% were recognized in the first year itself, right? But now even those costs have gone down because the revenue has also gone down. Naturally, expense matching principle, you will only recognize the proportion of cost in proportion to the revenue recognized. Anyways, now whenever such crazy accounting transitions happen, when businesses see huge impact on their figures, the companies usually choose to report figures in old accounting standards as well and under new accounting standards as well. Let me show you how. So usually whenever there is a huge impact due to any such significant transition in accounting standards or changes in policies, you will see the comparable figures present in either in the annual report or investor presentations, and likewise a similar analysis on which the management would have talked about in their con call discussions. So let me actually show you. Let's open page number 196. Now you will see on page number 196, they have explained the same thing which I just talked about. And you will see the balance sheet as per the old accounting standards and new accounting standards. How does this help us? So if you're trying to calculate the actual growth of business, you will be able to compare the figures from previous years, which by the way happen to be in old accounting standards, to the new figures reported in old accounting standards or comparable to the old accounting standards. Now remember, this figure, this column is precisely what is reported. Let me show you. Actually, this is balance sheet figure. As you can see, the equity saw a significant drawdown. Take a look at this. Like the equity which was reported last year was this much, and this year it's only 28,157. Why? Because there was a huge drawdown. And why is that? Because remember, aggressive revenue recognition as comparison in the eyes of the new accounting standards. I'm not going to call it aggressive revenue recognition because as per the old accounting standard, it was perfectly fine. But as per new accounting standards, you need to go pro rata basis. So you need to back out everything which was booked earlier and pass it on a recurring basis over the remaining life period of the contracts. All right, so let me actually show you the revenue figures. Now, when you actually see this restated figures, which is present on 198, before you take a look at this, let me actually show you once again the income statement, which is present on 172 page number. Now, if you see this figure of 223,899 lakhs, this is as per the new accounting standards, which is IND AS 115. So this is as per 115 and this is as per IND AS 18. Now, let me actually walk you through. So this is as per new numbers. So I'm just going to write it down for your reference, 223,899. This is as per new figures. Now, let me actually transition to the same page. I think it was 198. When you see this, take a look at the figures. The figures which we saw under IND AS 115 was 223,899. Yeah, precisely the reported figure. So as reported is as of IND AS 115, this is the impact. And if you remove that impact, you will see a revenue figure without 115. Now, the figure where we saw when comparing the old accounting standards and new accounting standards, we were thinking that there is a drop in revenues. But if we were to adjust the revenue figures as per the old accounting standards, you will see there is in fact an increase in revenue. So for comparison purposes or calculating revenue growth rate or a year-on-year growth rate, it makes sense to take these figures, which are the current year figures, but as per the old accounting standards, so that at least you make it comparable to the historical figures. Now, you can't really go back and change historical figures, but you can at least take current year's figures as per the old accounting standards to make things comparable, comparing apples and apples rather than oranges and apples, right? So precisely what you see here, for analysis perspective, you should have taken these figures. However, what happens, most of the data vendors, they tend to take the figures which are reported from income statement, which will happen to be the new accounting standards. And for people who source these figures from secondary sources would have made a mistake thinking that this business has gone through a revenue deterioration, which is clearly not the case, because in fact, the revenues seem to have increased a lot. Now, for analysis perspective, you should take this income statement, and once again, for analysis perspective, or historical growth rate computation perspective, you should take balance sheet, this one, which is, remember, this is without 116, and these were also without 116 because these were as per 18, IND AS 18, and this is again removing the IND AS 115 impact. It will fall down to IND AS 18 only. Similar analysis usually companies also give out on their con calls or investor presentations. Let me show you how to source that information. Open the Club Mahindra website. You can actually browse through the website. There's quite a lot of information, but hey, we are not here to buy their products, but we are in fact from an investor perspective. So you should go to the financials or investor section. So when we go to financial sections, you will see a lot of data points around con calls, and likewise, I'm not going to open con call for now, but let me go to investor presentation because it has some really good insights. Now I'm going to go to the investor presentation of FY19, which basically saw the transition of IND AS 115, and I'm going to open Q4 FY19 because it will include not only Q4 data but also accumulated full year FY19 data. Now, when you open this presentation, there's actually quite a lot of good information available explaining the change for investors to understand that this is not really a deterioration of a business, but it's an accounting standards change which has led to drop in revenues. It's not comparable over the years. For you to compare, you need to take the new figures as per the old accounting standards, but not the new accounting standards. To do that, let me actually walk you through directly through the highlights. You can refer to page number 5, which explains how the business works now. They are actually into a lot of revenue generation activities. They take admission fee, entitlement fee for vacation ownership, subscription fee, and likewise. Now I'm going to walk you through directly to the impact which they have explained for the accounting standard transition in slide 15. As you can see here, they used to recognize 60% of fees upfront and 40% was prorated over the period of the contract. However, under new accounting standards, it has to be over a period of tenure of the membership rather than no upfront recognition, which is why we see a huge drop in vacation ownership revenue. But technically speaking, it's not really a drop. You should judge it based on either comparing it with the old accounting standard figures, or you can also take a look at data points such as new customers onboarded and likewise. Actually, that makes a lot more sense in such businesses rather than taking directly dollar figures, which are not at all comparable across the accounting standard transition. Let me actually walk you through page number 31 as well. When you open page number 31, again, the same figures are available here. Why am I showing this? Because annual reports usually take time to release. For an analyst, you will have to go through quarterly presentations. So this data point is available well before the annual report. So in case you're tracking a company on a live basis, you'll get this data point in the company investor presentations first, and afterwards, when the annual report is released, you will get it there. So you will need to know how to browse through the company investor presentation as well. So this is as per IND AS 115. Now, obviously, as discussed, for comparison purposes, if you are trying to compute YOY basis, you should compare these two figures and not these and these figures. That will show a complete incorrect picture. So the figures which we were seeing earlier on a standalone basis, we saw a degrowth of 14%, which by the way is a growth of 5.7%. See the picture, the drastic nature and completely opposite analytics, which is generated by taking the right data and understanding the data, rather than blindly relying on secondary sources and picking data from various data vendors. Don't get me wrong, it's a brilliant way of doing things, but then you miss out on these micro details, which at times can play a huge role in investment thesis. All right, now walking you through page number 35 of the investor presentation, it also talks about what kind of tenure you see in terms of what kind of revenue generation potential you have in timeline for the next couple of years on a yearly basis. As you can see, under the new accounting standards, they are almost on an equal basis. Precisely why? Because pro rata basis. Why are they not equal? Because different contracts will have different maturities, right? So not all started on the same date, not all will end on the same date. Every year they have new clients onboarded, and likewise it grows. All right, now moving to slide 38, we will talk about how to, see these figures on a quarter basis or, yearly basis. Like I said, the annual report is available slightly late, but you can always refer to this. In fact, if you refer to the latest investor presentations, you will actually find these insights. Now, this is a screenshot from latest investor presentation. As you can see, the business has clearly shown that the FY19 figures were not comparable, but they have taken FY19 as of old accounting standards, which is IND AS 18, to compute the 4-year revenue growth rate. And for computing the revenue growth rate under the new years, the new regime of IND AS 115, there is no way you can generate figures of FY18, but FY19 IND AS 115 figures are present in the annual report. You take it. So going forward, you can compute revenue growth rate based on these figures. Now, you may be thinking, why is there a huge drop here? Obviously, because of the COVID, and this industry was worst hit, travel, and, where physical touch is usually involved. Proximity is involved, so which is where these businesses saw a huge impact due to COVID. But anyways, going forward for such businesses, you should always judge revenue growth rate under the new accounting standard. So if you were to judge the growth rate of potential of the business, the revenue CAGR of 10% is generated only till FY19. There is no way for you to compute that after FY19 under the new accounting standards. And FY21 was a one-off. All right. Hopefully you guys like the session. In case if you have any questions, please feel free to ask us in the comment section below. You can also refer to our forum. You can mention the comments here on our forum. This is in a written format for people who like to read stuff along with the screenshots. You can also follow us for more educative content on Instagram and YouTube, which is present here. Thank you so much for watching. I hope to see you in the next session. Thank you so much.